Hey everyone, and welcome. So, let's talk about options trading. It's that really fascinating corner of the market, the one that whispers about the potential for huge, life-changing returns, right? But let's get real for a second. Here's the cold, hard truth. Most beginners dive in and lose money, and I mean fast. Why? Well, it's because they make the same classic mistakes over and over. Today, we're going to change that.
So, you think you can beat the market? I love it. I love that ambition. And you know what? You absolutely can. But it's not about being some kind of stock picking genius right out of the gate. Nope. It's about something way more important.
And that's our whole goal today. See, before you can win, you have to learn how not to lose. We're going to seriously shorten that learning curve for you by walking through the 6 most common, most costly mistakes that trip everyone up. This is how you go from being a gambler just hoping for a lucky break to a real strategist who has a solid plan. All right, let's dive in. Okay, first up, the big one. Mistake number 1, buying naked options. This is, and I'm not kidding, probably the fastest way for a new trader to completely blow up their account. It's so tempting, too, because on the surface, it just looks like a simple high-reward bet. Let's break down exactly why it's so dangerous.
So what in the world is a naked option? Basically, it's when you buy a call, that's a bet the stock will go up, or you buy a put, a bet it'll go down, and that's it. It's all by itself with no other trade to hedge or protect you. You're making an all-or-nothing wager that a stock is going to move in the right direction by the right amount and in the right amount of time. And believe me, that is a much, much harder target to hit than you might think.
For a simple naked option to actually pay off, you don't just need one thing to go your way. You need a series of what feels like 4 near miracles. You have to predict the correct direction, obviously, but then the timing has to be perfect to beat something called time decay, which is literally the option's value melting away every single day. Then you have to pray the market volatility doesn't suddenly drop. And on top of all that, you have to exit at the perfect peak moment. The odds of all 4 of those lining up consistently, they're almost 0.
So, the takeaway here is crucial. The source material couldn't be clearer on this. Just don't do it. Unless it's a tiny piece of a much bigger, more complex, hedged strategy, buying naked options is just a losing game in the long run. Seriously, consider this your #1 rule for survival.
All right, let's move on to mistake number 2, and you'll see how these things build on each other. This one is the silent killer of so many options trades, underestimating time decay. Every single option you buy is like a melting ice cube. It's losing a little bit of its value every single day that passes, and that melting process speeds up like crazy as you get closer to expiration.
And this right here captures the frustration perfectly. You can be 100% right about where a stock is headed. You buy a call, the stock starts climbing just like you thought. But you look at your account and you're losing money. How is that even possible? It's because the stock isn't moving fast enough to outrun that ticking clock of time decay. It's honestly one of the most confusing and painful lessons for any new trader. Which brings us right to mistake number 3, and this one is a total paradox: chasing high volatility. You know, when the market's going nuts and prices are swinging all over the place, it seems like the perfect time to jump in and buy options, doesn't it? Well, it's not. It's usually one of the worst times. And here's why. When everyone is panicking, when fear and greed are cranked up to 11, all of that uncertainty gets baked right into the price of options, and they become incredibly expensive. You're basically buying hurricane insurance when the storm is already right offshore. So what happens when the panic fades and things get back to normal? All the air comes out of that balloon, and the value of your option can totally plummet, even if the stock moves in your favor. This is what traders call a volatility crush. A perfect example of this: just look at what happened during the Brexit vote back in 2016. The market was completely shocked, and the volatility index, the VIX, spiked over 30% in a single day. Options premiums were through the roof. So traders who jumped in and bought options in the middle of that panic paid a fortune, only to watch those same options lose a ton of value just a couple of days later as the market calmed down and volatility came crashing right back to earth. All right, let's talk discipline. Mistake number 4 is purely psychological, but man, it's a killer: not cutting your losses. A professional trader knows, they accept, that some trades are just going to go wrong. An amateur, on the other hand, holds on, just hoping and praying for a turnaround, and they end up turning a small, manageable loss into a catastrophic one. This is one of the oldest sayings on Wall Street, and there's a good reason for it. It's the absolute core of risk management. Your goal isn't to be right every single time. That's impossible.
Your goal is just to make sure that your winning trades are bigger than your losing trades. And you simply can't do that if you let one bad position wipe out 5 good ones. So how do the pros do it? They use hard rules. No emotion, just rules. Here's a fantastic one from our source. Never ever let a single trade lose more than 2 to 3% of your entire trading capital. This isn't just some friendly advice. It's a survival mechanism. It's what ensures that no single bad decision can ever take you out of the game. And that leads us directly into our 5th deadly sin, betting the farm, or, just putting way too much of your money into a single trade. It's so easy to get really excited about that one perfect setup and just go all in. But that is exactly how you can watch months of hard-earned profits completely vanish in a single afternoon. So here's the other side of that last rule. The pros don't just limit their losses, they limit their exposure from the very beginning. The rule of thumb is to limit your max exposure on any single trade to just 4 to 5% of your total capital. Let's make that real. If you have a $10,000 account, that means no single trade should have a worst-case scenario where you could lose more than $500. This forces you to stay diversified and make sure that even if you're dead wrong, you live to trade another day.
And finally, we get to mistake number 6. Now, this is the one that just bleeds you slowly over time, ignoring your brokerage fees. You might think, it's just a few dollars here and there, who cares? But trust me, over hundreds of trades, it can literally be the difference between being profitable and just breaking even.
Let's just look at the raw numbers here, right? From the source material. On the left, you've got a regular broker. In this example, they're charging 300 units a trade. On the right, a discount broker charging just 20. Now look at a common strategy like an iron condor. The cost is 1,200 versus 80. I mean, the difference is just staggering. Now, look at what that actually means for your bottom line. With that regular broker, over 36% of your potential profit on this trade is just gone, eaten up by fees before you even start. With the discount broker, it's less than 3%. Choosing the right broker isn't some small detail. It's a massive, massive part of your long-term success.
So what have we learned? We can actually boil this all down into a super simple 6-point pre-trade checklist. Before you even think about clicking that buy button, just run through these questions. This is what turns trading from an emotional impulse into a disciplined process. Are you avoiding the 6 deadly sins? If you can answer yes to all these, you are already way, way ahead of the game.
At the end of the day, it really just comes down to this one question. Gamblers rely on luck and hope. Traders rely on a process, on risk management, and on discipline. By learning to avoid these common mistakes first, you're building the foundation not just to survive in the world of options, but to actually thrive. Thanks so much for watching.